Hi, welcome to Symax Fintech weekly report. First of all, just a quick overview of our disclaimer. Trading does involve the risk of loss of capital and it's not suitable for everyone. As I say every week, hopefully it is for you. Many companies provide leverage, so just be aware of that because you can lose substantially more than your initial investment. The views, opinions and other information contained in this is just purely for educational purposes. We're not trying to encourage you to invest. We're not giving you advice. All we're doing is just giving you basically rundowns of how we see things, or specifically myself anyway. And of course, you should be carefully consider the risks that are involved, your financial situation, definitely your level of experience, especially in these markets, and your risk appetite. And of course, you should only risk capital that you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, then please seek financial advice before you start risking your capital. Okay, so if we sort of take a look back at what happened last week. So with US, we had CPI. It came out a beat. It was expected about 8.8. It came out at 9.1. Although the core was slightly lower, we've got to take that into consideration. Retail sales on Friday was also up 1%. So the US economy is still very hot. Jobless claims did increase though, and again, perhaps a little bit of a surprise there considering the amount of jobs that are available. Stock market dropped during the week. It did have a bit of a bounce on Friday after the data. The biggest surprise of the week was probably Bank of Canada. They came out with a full 1% increase. Their rates are now standing at 2.5% already. COVID cases are increasing again. Twitter are suing Musk because he's backed out of the deal to buy Twitter at the moment. Who can blame him with the share price is lower? And of course, just think he's managed to sell lots of Tesla shares and he's sitting with a very healthy bank balance at the moment from selling all those shares. Bank earnings were mixed. JP Morgan's missed. And then when we look at Chinese GDP, that again was very low, 0.4%. It's the worst for 2 years, because they've got these lockdowns going on still. Their target for this year is 5.5% growth. And, it's possible they may only see 3.5%. So again, there's another 5-6 months of the year left, so we'll have to wait and see how that goes on. Draghi offered to resign as Italian Prime Minister, which was rejected by the President. So hopefully he can form another government, but Italy does have lots of economic problems at the moment. The competition to replace Boris is continuing with live debates, and that is going to continue until there's only 2 left. Then I'm not sure what the process is apart from voting by members. And of course, UK data came out slightly better than expected. The UK is not in a good place, so seeing that data come out slightly better is fine. But households are being stretched by inflation in the UK for sure, and I'm sure in other countries as well. But as I'm based in the UK, I can speak about it much easier. The key data for this week on the US, we've got housing, the Philly Fed and PMI. For the UK, we've got CPI, PPI, retail sales, PMI, housing data, earnings, unemployment, so a full card basically for the UK. And of course, this week we've got the ECB meeting, and we have to expect something there for sure. It's just a matter of how big they're prepared to go. And along with that, there's PPI and housing data, PMI, and then we've got rate decisions, CPI and PMI from Bank of Japan also. Now, the macro outlook, again, it's inflation, inflation, inflation. Shrinkflation is there as well. Stagflation is approaching, if not already there in some countries, and recessions are definitely on the cards for next year, if not at the late this year. It's really going to depend on how aggressive these central banks remain. Supply chain issues are still with us, and partly because of the China lockdowns that are still going on, but also, just because of the Russian invasion of Ukraine that's now sort of maybe about 5 months old. I've lost track of that, but it's still ongoing. There doesn't seem to be much progress either side at the moment. But it is disrupting energy and food, and it's boosting the inflation for that. Although I must say that the cost of grains and metals have come down. Of course, there's this lack of workers that's still present at the moment. And of course, that's still building the earnings pressure in most countries. Some countries are heading for recession, but as I keep saying, it really depends on how aggressive these central banks remain. COVID cases are increasing also. Now, that is something to watch, because I'm not sure we're going to go into lockdown, certainly not in the near future. And, we're in the summer period in the Western world, so it seems very strange that we are seeing these increases. And we just got to watch out for any more mutations and what type they are, and then just take it from there. But again, further down as we come towards the end of this year, COVID could yet turn and give us more problems. Now, the EU still have not sent any financial aid that they promised to Ukraine. Possibly that, with the recession fears growing, they're trying to hold that money back for themselves. I don't really know, but Ukraine certainly need it. And US banks are likely to be fined for allowing their staff to use messaging services. The top 5 in the US looking like they're all going to get fined about 200 million each. Of course, the question is always, if they're willing to pay that, what was the benefits in the first place? Manchin, who is actually a Democrat, so he's part of Biden's government, is seen to reject the climate spending measures, along with obviously lots of the Republicans. That's going to make it much harder for Biden to get that through. Grains and metals, as I mentioned, are lower. Back basically to the start of this year, so before the Russian invasion, and of course we're watching gold. It's below 1700. Oil, 105 was the high this week, roughly down to around about $90, so $15 range, and it closed mid-range as well, about 97.5. So it's going to be interesting to see where that goes from this week coming. For me, it just seems that we're getting to this point when it comes to oil that people that are willing to buy from Russia when Europe's not are then freeing up oil from other countries for Europe and other countries that are imposing sanctions against Russia to go out and buy that oil, because that's being released for other buyers. So for me, it's just like, usually you shop in one supermarket, you're now shopping in another supermarket, but because you're shopping in the other supermarket, maybe other people have gone to the one that you've left. So hopefully you get my idea there. So, but overall, it just doesn't seem to me really logically that there is this shortage that everyone talks about when it comes to oil. That doesn't mean the oil price is going to crash. Although, there is going to be more pressure put on oil prices if recessions start to take hold. The dollar remains steady all week. And of course, especially against the pound and the euro, because there's not too much good coming out of those economies at the moment. This week will be interesting to see what the ECB does, because that is probably going to define which way the euro goes from parity with the dollar. And Bitcoin had quite a reasonable week, I would say. It stayed in roughly a $2,000 range, just either side of 20,000. Little trading tip of the week, revenge trading. So I'm sure most of you know what that is. If you're already trading, I'm sure most of you have probably experienced it as well. So, revenge trading is when you take in losses and you jump back into the market to try and make back the money you've lost. Don't do it. I've got a set of rules and just to give you an idea. So for me, if I have 3 consecutive losing trades, which is rare, I stop. And that's got to be for a minimum of an hour, perhaps for the rest of the session. So, I suggest that you sort of look at that. It depends how many times you're trading per day to how you set these rules up. And it should be part of your just your trading plan, really. But just think about that. Because if by stopping, it gives you a chance to relax rather than getting straight back into the market, trying to chase that loss, because all you end up generally doing is just compounding it and making the situation worse. And then, of course, at the end of it, you regret the fact that you did that. So just if you can think about doing that, just limit the maximum loss per trade as well, financially, per session, per week, per month. Get control over your capital that you're using to invest and trade with. But there's a second type of revenge trading as well, I believe, and that comes from taking profits. So, the market's moved in our favour. We've taken our profit and we think, wow, it wasn't that a good job. And then the market continues to keep going. And now we think, God, we could have had more out of that. And it keeps going. And you think, oh, it's gone too far now. Now it's got to reverse. And so you end up taking the opposite position. But you're doing it really because you cut your profits too early. So, just be careful of that. So, think about your initial position. You put that position on because you thought the market was going in one direction. And just because it's continued after you got out doesn't mean it's going to stop. So for me, that's a sort of a second type of revenge trading. So I just thought I'd mention that. Okay, so now we're going to look at some technical analysis. Just go through, before I do that, so here's a legend of what you're going to see. The black numbers on the right hand axis are showing you the levels from any trend lines, support and resistance. Any brown numbers are breakouts unless they are part of the pivot points, as shown below. And then any claret numbers are just horizontal levels where I've matched up 2 or 3 tops or bottoms. And on the right hand side, just so you've got an idea of the colours of the Fibonacci's that I use from time to time as well. Okay, so here we go. So the Dow Jones, the stock markets were lower until Friday. They rallied a bit. So why would they rally? Inflation's still hot. Well, maybe investors are now becoming of the opinion that, and if it doesn't get too aggressive and inflation doesn't, it's beginning to peak, which we're all hoping for, then perhaps the Fed will not have to be so aggressive with their rate hikes. So up here, I've got a level, but obviously it's quite a way away at the moment. And I've managed to get in these couple of resistance levels, and there's a couple of support levels down there for you as well. Obviously, that's based on the daily. So when we look at the 30-minute, as I say, it closed stronger on Friday. It held at the pivot level during the morning, and then it came up and it managed to close above R2, which is the second resistance level. So again, it's just another couple of levels there for you.